In this video, I'm going to teach you my 15-second scalping strategy to help you get in and out of the market quickly while still taking high quality trades. This is the strategy I use every single day. I teach it in my mentorships, and some people may have told you that using lower time frames like this is really difficult and you can't be profitable, but this might just be what you're missing. Now, this 15-second strategy isn't something I learned from someone. It came from trial and error and just learning what works for me. It definitely is a more aggressive approach to trading for more risk tolerant traders, but it will definitely give you an edge in the market. And like I said, it'll help you be in and out super quickly and still take those high quality trades that you want to take. So before I get into the strategy and break everything down, number one, I'm a scalper. And this means that in my strategy, I'm going to be using bigger position sizes for smaller price movements within a short period of time, from seconds to minutes. Number two, I'm going to be trading on lower time frames so that I can get early entries and short-term but volatile price movements. And last, I trade the open of New York session because it makes using the 15-second a lot easier because of the volatility. But if you trade a less volatile session, you can still use the same concepts on higher time frames. Now, getting into the actual strategy, it's very important that you guys understand the base of the strategy revolves around first identifying key areas of interest on the chart and looking at level 2 data to see where buyers and sellers are at so that I can figure out where do I actually want to be active in the market. Once I figure that out, that's when I'm going to start analyzing price and volume and just figuring out, okay, well, now that I'm at these key areas, when and why should I actually take this trade? Do I actually have my confirmation? Once you have that confirmation, that's when you're going to use this 15-second strategy so that you can get early entries and be in and out of the market super quickly, like I said. So what this means is that the 15-second alone is not for overall analysis or confirmation, but once I do have my directional bias, then I'm going to go to the 15-second chart and get my actual entry, where I want to add into the position, trail however I want to, and it's just going to be an enhancement. So if you don't trade exactly how I trade, you can actually still use this to enhance your own strategy. And even if you trade on higher time frames, you can still use this concept and apply it to your trading. Now, the reason I really love this strategy is because it allows me to be in and out of the market while others are still thinking about taking a trade or waiting for confirmation. So instead of having to sit in a trade for 30 minutes or even hours at a time, I'm usually done within the first 15 to 30 minutes of open. And the trade itself usually lasts no longer than 5 minutes. And the best part about this strategy is if you use it correctly, you're going to at least be able to double your risk to reward, or even sometimes you can go from 1 to 2 to 1 to 4 and then 1 to 2 to 1 to 8, just depending on the trade. So it's really, really great. And just so you guys can see how good this strategy is, I'm going to go ahead and show you a comparison between a really common strategy that a lot of people use and then this strategy. Okay, so to keep this comparison fair, we're going to use a consistent dollar risk for both strategies. So we're going to use 500, and this is just so that you can see the difference in everything else while the risk stays the same. Because if you're a trader and I'm teaching you one thing and another trader teach you another thing, regardless of your account size, you can only risk so much. So if you can risk so much with what both traders are teaching, at that point, the only thing that's going to help you determine what you like better is going to be, how long you're sitting in the trade, how easy the strategy is to understand, how big your stop is, how big your take profit is, how big the risk reward is, just different stuff like that. Okay. So we're going to start with a $500 risk for both of these trades. Now I'm going to use this chart. This is going to be from June 20th at 9:30 a.m. EST. And for the first strategy, let's just call this the ABC NQ strategy. Now I use order blocks. I call them supply and demand zones, whatever. I know a lot of traders use those as well. They might call them order blocks, whatever. So let's just use that for this example. Okay, so we have this 1 hour, I'm going to call it a supply zone, right? Where we have this small green basing candle, big imbalance candle. And so I have that marked from the open to the high of that zone here. Let me make it right. Okay, and then we also have down here this 3 hour demand zone. Okay, and actually if I make it a bit smaller, to actually line up with the zone, it's going to be right around here. Okay, so we have the open to low, right, marked out for the zone, and then we have that big imbalance candle, and so we have our demand zone. All right, so we're going to use these two zones. All right, now a lot of traders, they don't use lower time frames. A lot of them, which you guys may know, may take trades and get entries on the 5 minute or the 15 or even the 30 minute. Okay, the 15-second is not a common thing at all. So let's just use the 30 minute for example. All right, let's just make it super simple. We have someone trading. They're going to trade up into the zone, and if there's a reaction in the zone, they'll get an entry and they'll just target the next zone down. Okay, pretty simple. A lot of people do that. Nothing wrong with it. Okay, so let's just watch it play out. All right. We know we have our $500 risk. We see we tap into the zone. We see price wick up out the zone. So we see the reaction there. So let's just say you're a trader who uses this strategy. Super simple. You hop in where that 30-minute closes, right? And you place your stop above the zone and you just target right down into the next zone. Again, super easy, super simple. A lot of people do it. All right. So what we see here is we have a 243 tick stop loss, right? Or 60 points or so. Okay. Our TP is around 677 ticks and, or 169 points, right? And the risk to reward ratio is going to be 2.79. Okay. So we are only risking $500 because we have to keep this fair when we're talking about both strategies. All right. So to have a $500 risk, honestly, I don't even think you would be able to trade minis with NASDAQ with 243 tick stop loss and a $500 risk. So you honestly would have to go down to micro. So let's see how much that would be. Okay, so I did the math, and to maintain a $500 risk in this trade, you would have to trade 4 micro contracts with NASDAQ. Okay, so you would be risking 500, and then with the TP of 677 ticks, you'd be making about $1,300. So that's your 2.79 risk to reward ratio, 500 to 1,300. Okay. So that's pretty good. That's really good. Great risk to reward. You're making a lot of money. You're not risking a whole lot. Okay. And then let's just play it out just so you guys can see, right? It worked out. We didn't get stopped out, tapped right into the zone and moved down to hit full TP, right? So you didn't risk more than $500 and you went and you made your 1,300. All right. Now let me show you the difference in this strategy versus my strategy, because in this trade, this person would have had to sit in this trade for an hour. Okay. Again, with the 2.79 risk reward ratio, making 1,300, not bad, but let me show you the difference. So like I said, I like to trade on lower time frames once I already have my overall directional bias. So I have the supply zone, right? I have sellers above me as well, you know, before price moved up, right? This is from Bookmap, so it helps you to see where buyers and sellers are passively sitting in the market, and you can use this when you're trading. Okay, so a lot of times what I like to do is wait for price to grab liquidity above the level, especially when we have other confluences like this supply zone, for example. And then once price closes back below that level, I like to get my entry, right? So this is a real life trade that I took, right? And I got my entry as soon as price broke right below that level. Okay, and had my stop just right above it. And again, guys, this is the same exact day as the previous example, same exact trade. Okay, but I'm just trading it differently. Okay, so you're gonna see the difference. All right, so remember, we're not risking any more than $500. And like I said, I like to catch the flush of a move and really just get out before there's any pullback or any chop. Okay, so in this case, the flush, you can see it here, is within these first 4 candles. And then we kind of get that first pullback on this 1-minute chart on this green candle. So I probably would have gotten stopped out once price pulled back a bit from there. Okay, so right around 200 ticks. So let's look at the risk to reward. Okay, we're not risking any more than $500. All right, we have a 45 tick stop or 11 points, 218 tick take profit or 54 points. Okay, so we're risking no more than 500. We're going to be in 2 mini contracts for NASDAQ. Again, that's a huge difference than trading 4 micros like in the other example to maintain that $500 risk, right? So if you're using someone else's strategy like that, if you're trading with someone who has stops that big, right, and risk rewards like that, that's fine, but you're going to have to trade lower size to maintain your risk. This type of trading, you can maintain your risk and trade bigger size, like I said before. Okay, so in this trade, we're going to start in 2 mini contracts, right? So that means our initial risk reward is going to be 500 risk, and let's just round it down to $2,000 reward, right? That's the initial risk reward. Remember, I told you this 15-second strategy can help you at least double your risk reward, okay? So we're starting with a 1 to 4, actually, 1 to 5. We can really round it up. 4.84. So 1 to 5 risk reward. That is way better than the previous 1 to 2.79 or what risk reward, right? Okay. So let's look at the 15 seconds so I can show you how I use this to double my risk to reward. Okay. So like I said, the same way that you can use a 30-minute chart or a 1-minute chart or a 1-hour chart, right? To look at structure, you can use the 15-second as well. Okay. But you want to have your overall directional bias first. Okay, so in this case, I got my initial entry once price closed back below this level. And then look what formed on the 15-second. Okay, look what formed. It's very clear. We have this clear level of baby support, right? You got this baby support here. And look what happens as soon as we get the break of that baby support on the 15, right? We retest it and price flushes. Okay, this is a lot of times what my trades look like. I get my initial entry. I scale down to a lower time frame like the 15-second. I look for some sort of structure. I add once we get the break of structure, and then price flushes. Okay. So if I'm initially in 2 contracts and I add 2 contracts to double my position size, right? So now I'm in 4 contracts, right? My average entry is going to move down a little bit because my first entry was up here. My second one was down here. So the average is going to move down. Okay. But really, since I'm trading with structure like this, once we get that break, my stop can really just be anywhere right above that 22,090 level, 2290. Okay, so whether that's literally break even, or honestly, it would be at break even because you just have your stop right above the level, right? You see how that works when you're trading with structure on lower time frames during a volatile session? You can move your stop a lot faster so that you can lock in profits and trade bigger contract sizes and not risk as much. Okay, so now we're in 4 contracts, right? Our average entry did move down, right? So the TP was 200. Let's just say now, let's round it down a little bit just so I can be fair. Let's just make it 190, right? Okay, so even if your TP is 190, right? 190 ticks. Okay, let's just, so I can show you, for example, right? Even if we have a TP of 190 ticks, right? We're now in 4 contracts. We're not even risking anything at this point because we're trading based off structure on the lower time frame after we have our overall directional bias, right? At this point, let's figure out what our risk to reward would be. So even if I'm still risking $500, once you double your position size in this trade specifically to 2 minis to 4, you're now going to be making $3,800. So initially 2,000, now 3,800. So you're nearly doubling your position size and bringing your risk to reward from 1 to 5 to 1 to 7. Okay, so you see how that works? Same exact trade. You're not risking anything more than what you wanted to risk initially, but because you're scaling down to a lower time frame, you're looking at structure to see, okay, well, since I have my overall bias already, I'm already in the trade, what other structure can I use to add into this position and capitalize off of price moving in my direction instead of being afraid and starting to scale out as soon as price starts moving in my direction. That's going to make a huge difference in this trading strategy and other trading strategies. Also, take note that this trade was from 9:46 a.m. and I got out at 9:51. So that's 6 minutes compared to an hour in the other trade, risking 500 to make 1,300. Again, there's nothing wrong with it, but you can see the difference, okay? And this is not me making up something. I know traders who use the other strategy, and I know myself who uses this strategy, right? I just used this. I just took this trade last Friday with my Discord community, okay? So it's really, 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 really awesome and really amazing. So just to recap, the basis of this 15-second strategy is once you have your overall directional bias, use the 15-second to get your early entry and add once other traders have their confirmation and they're hopping in while the price is moving in your direction. Okay. Once price is flushing, moving in your direction, go ahead and get out the trade before there's any major pullback or major chop and you've secured your profits. Now, if you're still questioning the 15-second chart, just think about it this way. The same way you can get an entry on a 30-minute chart or even a 1-hour chart based on structure, you can do the same thing based off of a 15-second, and you're going to be in and out super quickly. You're going to have tight stops, big risk to reward ratios. It's 100% worth it. If this strategy made sense to you and you want help applying it or just practicing it more in real time, I have a 6-week mentorship coming up July 28th, and I'm going to be breaking down my entire strategy step by step, including everything and more that I just talked about. So if you're interested, use the code YouTube to get 10% off. I'm going to put the link in the description, but this is for traders who want to be consistent, traders who are serious, and they want to really see growth. I hope you guys enjoyed this video. Don't forget to like, comment, and subscribe, and I'll see you guys next time.